Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes intergalactic supremacy and is the most attractive home improvement corporation going forward. The first Stock Wars combatant in this battle is Home Depot. Home Depot is the largest home improvement retailer in the United States, supplying tools, construction products, and services. The company is headquartered in Atlanta, Georgia, and was founded in 1960. The company primarily serves homeowners and professional renovators, remodelers, general contractors, handymen, property managers, building service contractors, and specialty tradesmen such as electricians, plumbers, and painters. As of 4 August 2020, the company operated 2,293 retail stores in 50 states and the District of Columbia, Puerto Rico, the U.S. Virgin Islands, Guam, 10 Canadian provinces, and Mexico. The second combatant is Lowe's. Lowe's is an American retail company specializing in home improvement, founded in 1946. Headquartered in Mooresville, North Carolina, the company operates a chain of retail stores in the United States and Canada. Lowe's Companies, together with its subsidiaries, operates as a home improvement retailer in the United States, Canada, and Mexico. The company offers a line of products for construction, maintenance, repair, remodeling, and decorating. It provides home improvement products in various categories such as appliances, decor, paint, hardware, millwork, lawn and garden, lighting, lumber and building materials, flooring, kitchen and bath, rough plumbing and electrical, seasonal and outdoor living, and of course, tools. Let the battle begin! Home Depot is currently trading at $279.31 and is up over 23% year to date. Over the last 5 years, Home Depot is up over 137%. Lowe's, our other home improvement juggernaut, which is trading at $166.49, is up this year as well, seeing almost a 56% increase. With that said, Lowe's is also up over 137% during the last 5 years. Now let's look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it's an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, Home Depot is the larger corporation, clocking in at $306 billion, compared to $129 billion for Lowe's. Both are home improvement juggernauts, but Home Depot takes the first metric comparison in Stock Wars with $177 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who do you think generates more revenue? In 2019, Home Depot had $110 billion in revenue, while Lowe's came in at $72 billion. Home Depot wins the second consecutive metric in this battle against Lowe's. The third metric comparison in Stock Wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the third metric in a row, Home Depot takes the win with $11.2 billion in profit, while Lowe's came in at a meager $4.2 billion. Knowing the profit for each combatant transitions into the next metric in this Stock Wars comparison: profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or a business activity makes money. It represents what percentage of sales have turned into profits. Home Depot comes in with a profit margin of 10.16%, while Lowe's is at 5.82%. For the fourth metric in a row, Home Depot wins. Both corporations have a decent profit margin for home improvement companies. As the stock wars rage and Home Depot maintains a 4-0 lead, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding. Home Depot boasts a 3-year revenue increase of 9.4%, while Lowe's falls again with a 3-year revenue increase of 7.9%. As the combatants battle for home improvement domination, PE ratio emerges as the sixth metric in stock wars. The price-to-earnings ratio is the ratio for valuing a company that measures its current share price relative to its per-share earnings. The price-to-earnings ratio is also sometimes known as the price multiple or the earnings multiple. When examining the forward PE, Home Depot comes in with a metric of 24.35, while Lowe's sees their forward PE at 20.15. Lowe's comes out on top for the first time in this stock wars matchup. As the battle rages between these two home improvement titans, dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Home Depot comes in with a dividend yield of 2.11%. Lowe's, on the other hand, is at a lower 1.4% yield. Once again, Home Depot wins another metric. Both yields are relatively modest. Moving on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the two combatants, Home Depot has 11 years of dividend growth, while Lowe's boasts 57 years of consecutive increases. In this metrics battle, the dividend king Lowe's prevails. Now on to 5-year dividend growth, which is the next metric in the stock wars battle between these home improvement juggernauts. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividends paid to their investors on a regular basis. According to Fidelity, Home Depot has a 5-year dividend growth rate of 20.52% compared to Lowe's at 16.47%. Once again, Home Depot claims the metric in this stock wars matchup. This begs the question for the next metric: how safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Home Depot has a score of 87, which is considered very safe. Lowe's has a score of 93, which is also considered very safe. Lowe's is the victor of this stock wars metric. The 11th metric in the stock wars contest also reflects on dividend safety: payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. This is expressed as a percentage of the company's total earnings. Currently, Home Depot's payout ratio is at 54.95%, while Lowe's clocks in at 31.91%. Both payout ratios are attractive, but Lowe's is the winner of this stock wars metric. Moving on quickly to the 12th metric, the two home improvement combatants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. Home Depot jumps into the fray with a current ratio of 1.3. Lowe's, on the other hand, also sees their current ratio at 1.3. The higher the current ratio, the better. Therefore, for the first time in Stock Wars, we have a draw in a metric. Both have solid current ratios. The next metric is the debt-to-equity ratio in this Stock Wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statement. Home Depot sees a debt-to-equity ratio of -98, and Lowe's comes in at 6.01. Home Depot has the negative debt-to-equity ratio due to regular stock buybacks. Some analysts don't like how aggressive they are buying back shares. We'll give this one to Home Depot, as it seems that Lowe's is more aggressively financing with debt. In this Stock Wars showdown, Home Depot won 9 metrics compared to Lowe's, who won 5. Home Depot is the winner of this epic Stock Wars battle of home improvement titans. Despite Home Depot's win here from a metric standpoint, both companies are moderately overpriced here in the current market. That being said, both may be a compelling investment option at their current prices, depending on risk tolerance and your strategy and longevity in the market. If you are interested in a deep dive into Lowe's, please check out my colleague Stock Ninja's recent video on the subject. I'll leave a link in the description. If you missed the first 2 episodes of Stock Wars matchups between ExxonMobil and Chevron, or JP Morgan and Bank of America, I'll leave the links in the description. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notifications so you don't miss any future episodes. Comment below if there is a particular battle you'd like to see. Until next time, remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.